Good evening, Garage Gang. It's Monday night, January 26th. The lights are low, the screens are loud, and Wall Street just ripped like nothing in the world is wrong. I'm Avatar John. This is The Garage. And before we go any further, one real quick plug, because this matters. We just crossed 150,000 subscribers on YouTube and 15,000 on TikTok. That doesn't happen by accident. That happens because this room is filled with people who think ahead, not sideways. So smash the like, share this with your fellow Deegans, and hit follow, because what we're building here compounds. All right, let's work. Today, TradFi popped. On the surface, it looked bullish. Dow up 300 points. Mega cap tech caught bids. Risk assets breathed. But this wasn't optimism. This was contracts getting signed. The loudest signal today came from AI infrastructure. CoreWeave surged after announcing a massive expansion of its partnership with NVIDIA, including a multi-billion-dollar investment tied to AI data centers. Now let's be precise, CoreWeave is not a meme cloud company, and they're not a traditional crypto miner anymore. They started with mining DNA, GPUs, power contracts, cooling, hardware discipline, and they pivoted early into GPU native AI data centers. That's why this deal mattered. NVIDIA didn't write a check for hype. They wrote a check for guaranteed compute capacity, AI factories, real racks, real power draw, real execution, and yes, full transparency, the garage has been invested in CoreWeave. Not today, not on the headline. We were early because we understood something most people missed. The miners who survived the last cycle weren't idiots. They were training for the next one. Crypto mining taught them how to survive thin margins. AI turned that skill set into critical infrastructure. So when CoreWeave pumped today, that wasn't luck. That was thesis validation. Markets reward execution. Now layer that on top of commodities. Gold didn't just go up today. Gold cemented itself. Multiple reports now confirm gold has overtaken the US dollar. Read that again. Not Bitcoin, not bonds, gold. That's not a trade, that's a confidence transfer. At the same time, the dollar index slid to a 4-month low ahead of the Fed meeting, and stocks still ripped. Why? Because liquidity and fear are no longer synchronized. Then silver detonates, up as much as 14%, the biggest move since 2008. Silver doesn't do that when markets are calm. Now healthcare. United Health drops more than 9% after flat Medicare reimbursement rates are proposed. Same month, a sitting U.S. congressman sold up to $500,000 of United Health stock. Same congressman sits on the House Subcommittee on Health. That's not noise, that's timing, and markets price timing. Then Trump announces 25% tariffs on South Korean cars, pharmaceuticals, and lumber. That's inflation pressure re-entering through a side door. Tariffs are taxes wearing a flag, and quietly and almost politely, the U.S. moves an aircraft carrier into the Middle East. Energy risk, shipping risk, yet the market rallies anyway. Why? Because today's rally wasn't about safety, it was about capital moving first. Now look at crypto. Bitcoin didn't moon, Bitcoin didn't panic, Bitcoin was controlled. When gold and silver scream, the dollar bleeds, stocks party, and Bitcoin hold. That's not weakness, that's positioning. Ethereum stayed boring and exactly what it does before it matters. Solana stayed restless. Speculation's still alive. Even GameStop pops 7% just to remind everyone that liquidity never disappears, it just changes costumes. So here's the takeaway from chapter 1. Today wasn't bullish or bearish, it was revealing. AI infrastructure got locked in, gold reclaimed trust, the dollar softened, tariffs returned, energy risk rose. Markets didn't rally because the future is safe, they rallied because the people with money already chose where it's going, and now we get honest. Let's start with the one place that never lies, the bond market. If this rally meant confidence, treasuries would have relaxed. They didn't. Yield stayed elevated, duration stayed heavy, volatility stayed bid. That's the bond market saying, I see the stress. Now credit, the silent killer. Nobody wants to say this on TV. Credit is tightening, not tomorrow, not eventually, now. High rates plus slowing growth plus AI-driven layoffs don't hit stock prices first. They hit cash flow, they hit refinancing windows. Commercial real estate is still bleeding quietly. Office loans are rolling. Regional banks are still carrying exposure they don't want to talk about. AI doesn't just replace workers, it reveals leverage. Every efficiency gain is a stress test on debt. Now look at market breadth. This rally was thin. Small caps didn't lead, mid caps didn't confirm, regional banks didn't breathe. The only things that moved were scale, infrastructure, and narrative darlings. That's not bullish, That's selective survival, now energy. Geopolitical risk just stepped higher. Insurance costs don't wait for wars to start. Oil hasn't caught up yet. That's not comfort, that's lag. Now let's talk about retail, because this is where the trap gets set. Retail saw green and exhaled. That's weakness. Relief is not confirmation, it's sedation. Retail didn't get safer today, they got louder, they chased green candles. And while that noise plays out, AI is hollowing out the middle of the economy. Google drops AI into photos. No app, no onboarding. Amazon cuts tens of thousands of white-collar jobs, not warehouse labor, corporate roles, managers, analysts, HR, operations. AI doesn't negotiate, it doesn't complain. This is the real sequence. AI increases output. Management notices redundancy. Automation gains leverage. That's why money is flowing into data centers instead of apps. That's why AI infrastructure is getting locked in with real contracts. Now, crypto, Bitcoin didn't pump today. Bitcoin held. That's not boring. That's a market that understands time preference. In a world where grids fail, trust erodes, and automation accelerates, Bitcoin doesn't need hype. It needs optional exits. This is not bull versus bear. This is who survives the compression. If you're waiting for certainty, you will be exit liquidity. The winners of the next decade won't be louder. They'll be more prepared, more liquid, more adaptable. They'll understand that stability is the reward. So here's your operator checklist. Watch the dollar, watch treasury yields, watch credit spreads, watch oil, watch Bitcoin relative strength, watch AI infrastructure. That's it. If this pissed you off, good. Anger means something landed. We don't do this show to make you feel better. We do it so you're not confused when the music stops. We'll be back tomorrow. Engines hot, safety off, let it rip.